In the 1880s, France believed it would build the greatest engineering project in history. The Panama Canal promised global trade dominance. It promised national prestige. It promised enormous returns for investors. Shares were sold to the public. Politicians endorsed the project. Newspapers promoted its inevitability. Ferdinand de Lesseps stood at the center of the vision, trusted after his success at Suez. But behind the promise was financial mismanagement, concealed losses, and political bribery. When the project collapsed in 1889, hundreds of thousands of investors were ruined. By 1892, the scandal exposed corruption at the highest levels of French politics. This was not just an engineering failure, it was one of the largest infrastructure scams of the 19th century. This is the Panama Canal stock scandal.
In 1869, the Suez Canal was officially opened to international traffic. The canal connected the Mediterranean Sea to the Red Sea. It eliminated the need for ships to navigate around the Cape of Good Hope. Travel time between Europe and Asia was reduced by thousands of kilometers. The project reshaped global trade routes almost immediately. The canal had been constructed under the leadership of Ferdinand de Lesseps. Lesseps was a former French diplomat with experience in Egypt. He secured concessions from the Egyptian government in 1854 and 1856. Construction began in 1859 and continued for 10 years. Despite technical and political challenges, the canal was completed. Its inauguration was celebrated across Europe. France viewed the project as a national achievement. The canal demonstrated that large-scale engineering could transform commerce. Shipping companies quickly adopted the new route. Toll revenues began to flow steadily. The financial model appeared validated. Investors who had purchased shares saw proof of viability. The canal became a symbol of modern infrastructure success. Lesseps was elevated to the status of national hero. He was granted honors and public recognition in France. His name became associated with competence and inevitability. The Suez Canal Company generated confidence in large infrastructure financing. The structure relied on public share subscriptions. Retail investors had participated in the offering. The returns reinforced trust in public infrastructure investment. By the 1870s, France believed it could rival British global dominance. Industrial growth increased appetite for overseas expansion. Infrastructure was seen as a pathway to national power. Capital markets in Paris were expanding. Middle-class investors were increasingly active in share ownership. The Suez experience created a template. A respected leader proposed a bold project. The public subscribed capital. Construction was completed. Trade revenues justified the risk. This sequence became embedded in financial memory. Lesseps's reputation reduced perceived uncertainty. Few questioned his judgment. Engineering success translated into financial credibility. Political leaders aligned themselves with his achievements. Newspapers praised his strategic vision. Public confidence became institutional confidence. Banks were willing to associate their names with his ventures. Parliament viewed him as a national asset. By the late 1870s, Lesseps possessed both social and political capital. He had proven that international infrastructure could be financed by public subscription. He had demonstrated that ambition could overcome geography. Investors did not see speculation, they saw precedent. The Suez Canal created a psychological anchor. It suggested that bold engineering promises could be realized. When Lesseps began speaking of a canal across Panama, the proposal did not appear radical. It appeared as a continuation of success. Credibility had already been established. That credibility would shape every financial decision that followed. In 1879, Ferdinand de Lesseps turned his attention to Central America.
He proposed the construction of a canal across the Isthmus of Panama. The objective was to connect the Atlantic Ocean to the Pacific Ocean. Such a canal would eliminate the need to navigate around Cape Horn. The proposal was presented at the International Congress in Paris in May 1879. Engineers, diplomats, and financiers attended the gathering. Lesseps advocated for a sea-level canal similar to Suez. He argued that modern engineering could overcome geographic obstacles. The terrain of Panama differed fundamentally from Egypt. Unlike the flat desert of Suez, Panama consisted of dense jungle and mountainous ridges. The region experienced heavy tropical rainfall. Rivers in the area were prone to flooding. Geological surveys were incomplete. Many technical experts warned that a sea-level canal would be extremely difficult. Alternative proposals recommended a lock-based system. A lock canal would raise and lower ships using engineered chambers. This design required complex hydraulic planning. Lesseps rejected the lock proposal. He viewed it as a compromise inconsistent with his prior success. His authority influenced the tone of the Congress. Delegates were inclined to defer to his judgment. The Congress ultimately endorsed the sea-level approach. The Compagnie Universelle du Canal Interocéanique was established in 1880. The company was structured as a publicly traded corporation. It relied on capital subscriptions from investors. Early cost estimates projected approximately 600 million francs. Completion was projected within 8 years. These projections assumed stable working conditions. They did not fully account for disease exposure. They underestimated excavation complexity. They did not reflect seasonal flooding disruptions. The initial prospectus emphasized global trade expansion. It highlighted expected toll revenues. It compared Panama to the proven success of Suez. Public messaging minimized engineering risk. Newspapers framed the project as inevitable. National pride reinforced investor interest. The canal was presented as France's next global achievement. Public enthusiasm translated into early subscriptions. Retail investors were heavily represented. Shares were marketed broadly to the middle class. The narrative focused on continuity with Suez. Few detailed risk disclosures were emphasized. Optimism replaced technical caution. Political leaders expressed support for the undertaking. Government oversight remained limited. The company was granted operational latitude. Construction preparations began in 1881. Early surveys revealed logistical obstacles. The Chagres River posed particular difficulty. Seasonal flooding threatened excavation sites. Despite these warnings, the sea-level design remained unchanged. Ambition had already defined the framework. Engineering reality would now confront financial expectation. In 1880, the Compagnie Universelle du Canal Interocéanique formally began raising capital. The company adopted a public subscription model similar to the Suez Canal. Shares were offered broadly to French investors. The pricing structure was designed to encourage middle-class participation. Retail investors formed a significant portion of early subscribers. Banks facilitated access to shares through installment payment plans. The company promoted the offering as a patriotic investment. Marketing materials emphasized continuity with Suez. Projected toll revenues were presented as reliable. Cost assumptions remained optimistic. Initial capital raised exceeded expectations. Construction began in 1881. Early expenditures were substantial. Excavation equipment had to be transported across the Atlantic. Infrastructure had to be built before excavation could scale. Operating costs increased rapidly. By 1882, additional capital was required. A second share issuance was approved. The company reassured investors that delays were temporary. Engineering setbacks were framed as manageable. New prospectuses were issued to maintain confidence. Newspapers continued to publish supportive coverage. Political leaders did not publicly question the project. The company began issuing bonds in addition to shares. Bonds offered fixed returns to attract cautious investors. Lottery bonds were later introduced to stimulate demand. These instruments blended speculation with fixed income appeal. The structure expanded the investor base. Small savers were increasingly exposed. Between 1880 and 1888, multiple capital raises were conducted. Each round relied on continued public optimism. Financial disclosures were selective. Losses were not fully transparent. Cost overruns were gradually accumulating. Disease among workers reduced productivity. Excavation progress lagged behind projections. Revenue generation remained years away. Cash flow was dependent entirely on new subscriptions. The project became capital-intensive without producing income. The company's survival depended on confidence. By 1885, hundreds of millions of francs had been spent. Total capital raised would eventually approach 1.2 billion francs. Estimates of final cost continued to rise. Internal financial pressure intensified. Public messaging remained optimistic. Shareholders were encouraged to maintain patience. Dividend expectations were deferred. The assumption remained that completion would resolve deficits. Investors relied on Lesseps' credibility. Few conducted independent engineering assessments. The market price of shares fluctuated with rumor. Speculation increased volatility. The financing structure required constant inflow of funds. Operational performance did not justify the scale of investment. Capital raising became a substitute for progress. The distinction between infrastructure development and financial maintenance began to narrow. The project now required sustained belief more than measurable results. Construction in Panama began in 1881 under a sea-level design. The objective required cutting through the Continental Divide. The most difficult section was the Culebra Cut. Excavation required removing millions of cubic meters of earth. The tropical climate imposed continuous strain. Annual rainfall in the region exceeded 3 meters. Heavy rains destabilized excavation walls. Landslides repeatedly buried completed work. Machinery imported from Europe deteriorated rapidly in humid conditions. Steel equipment corroded. Rail systems shifted under unstable ground. Logistical supply chains were inefficient. The Chagres River created persistent engineering risk. During rainy seasons, the river flooded excavation zones. Water management systems proved inadequate. Disease further reduced workforce capacity. Malaria spread among laborers. Yellow fever mortality rates were severe. Medical understanding of mosquito transmission was limited at the time. Worker turnover increased operational costs. Recruitment expenses rose. Productivity per worker declined. Excavation progress slowed below projections. Original timelines became unrealistic. By 1883, engineering reports indicated serious delays. Cost estimates were revised upward. The initial projection of approximately 600 million francs became insufficient. Expenditures accelerated beyond forecast. Earth removal volumes were underestimated. Geological instability was persistent. Sea-level excavation required deeper cuts than anticipated. Slope angles had to be widened for stability. Each adjustment increased material removal requirements. Transporting excavated soil required expanded rail networks. Temporary rail lines had to be continuously relocated. Equipment breakdowns were frequent. Repair facilities were limited. Supervisory turnover created coordination inefficiencies. Centralized planning from Paris did not reflect on-site realities. Reports sent to France were often optimistic. Engineering setbacks were framed as temporary obstacles. However, Cumulative delays expanded financial exposure. The company remained committed to the sea-level model. Reconsideration of a lock system was delayed. Capital expenditure continued without corresponding progress. Revenue generation remained distant. By the mid-1880s, it was clear that costs would exceed initial projections by a wide margin. The engineering challenge had become structural. The project required more capital than originally disclosed. Operational strain now translated directly into financial pressure. By 1884, the Panama project required continuous external financing. Operational costs exceeded incoming capital. Excavation expenses consumed available liquidity. Revenue generation remained years away. The company turned again to public markets. New share offerings were announced. Existing investors were encouraged to subscribe to protect prior investments. Bond issuances increased in scale. Fixed interest instruments were marketed as lower risk. Lottery bonds were introduced to stimulate retail demand. These bonds combined investment with prize incentives. Marketing emphasized guaranteed structure rather than engineering uncertainty. Public confidence remained essential. Between 1884 and 1888, repeated capital raises occurred. Each issuance depended on sustained optimism. Internal accounting became increasingly complex. Costs were capitalized to defer recognition of losses. Project timelines were extended in official communications. Deficit levels were not fully disclosed to retail investors. Cash flow statements emphasized future toll potential. Engineering setbacks were described as manageable delays. Expenditure reporting lacked transparency. Administrative costs increased alongside construction costs. Intermediaries received commissions for bond placement. Financial press continued supportive coverage. Critical engineering assessments were not widely circulated. Political figures publicly defended the project. The company's survival relied on continuous subscription inflows. Without new funds, payroll and equipment maintenance would halt. By 1886, liquidity strain intensified. Short-term borrowing supplemented long-term capital. Interest obligations accumulated. Debt service added to operational burden. Internal projections indicated capital exhaustion, yet public messaging remained confident. Completion estimates were repeatedly revised. Projected toll revenues were recalculated upward. Financial models assumed eventual stabilization. Share prices fluctuated with each subscription announcement. Speculative trading increased volatility. Retail investors reinvested dividends from other ventures. Many believed temporary setbacks would resolve. The Suez precedent continued to anchor expectations. Few recognized that Panama's cost structure differed fundamentally. Capital raising substituted for measurable progress. Accounting practices obscured cumulative losses. Bond placements became more aggressive. Distribution networks expanded across provincial France. Savings from small towns flowed into the project. The distinction between infrastructure financing and speculative rollover narrowed. By 1888, total capital raised approached 1.2 billion francs. Operational results did not justify the scale of expenditure. The project now required belief to sustain liquidity. Financial illusion had replaced engineering validation. By the mid-1880s, financial pressure on the Panama Canal Company intensified. Engineering progress did not justify continued capital expansion. Liquidity shortages became increasingly frequent. Executives recognized that public confidence had to be preserved. Political alignment became central to survival. Senior company officials began cultivating parliamentary relationships. Members of the French Chamber of Deputies were approached. Financial support was exchanged for favorable legislative treatment. Bribery payments were concealed through intermediaries. Approximately 150 parliamentarians were later implicated. Payments were structured to avoid direct traceability. Journalists were also targeted. Subsidized articles appeared in supportive newspapers. Critical reporting was discouraged. Media influence reduced public scrutiny. Government regulators did not intervene decisively. Oversight mechanisms remained limited. Requests for additional bond approvals passed through Parliament. Political endorsement reinforced perceived legitimacy. Retail investors interpreted legislative approval as validation. Internal financial distress was not publicly disclosed. Company accounts remained opaque. Losses were deferred within accounting structures. Public statements emphasized temporary setbacks. Confidence remained the central asset. By 1887, fundraising required explicit parliamentary authorization. Executives intensified political lobbying. Lottery bond authorization depended on legislative approval. Debate within Parliament was influenced by undisclosed payments. Press campaigns framed opposition as anti-national. National prestige was used to silence skepticism. Critics were marginalized. Engineering feasibility was rarely debated in public. Instead, discussion focused on France's global standing. Lesseps continued to present a composed public image. His reputation shielded scrutiny. Political elites feared reputational damage if the project failed. Admitting structural problems would undermine prior endorsements. Institutional incentives favored continuation. Each new bond issuance postponed exposure. Public belief was sustained through coordinated messaging. The company's balance sheet deteriorated. Interest obligations accumulated. Construction lagged further behind projections. Private doubts expanded among insiders. However, disclosure would trigger collapse. Political protection became a financial instrument. Institutional credibility replaced operational validation. The canal project was now sustained by influence rather than output. The structure relied on delay. By 1888, the gap between public narrative and internal reality had widened significantly. When liquidity ultimately failed, political insulation could no longer prevent bankruptcy. By 1888, the company's financial position had become unsustainable. Capital subscriptions slowed significantly. Bond sales no longer generated sufficient liquidity. Interest obligations continued to accumulate. Operational costs remained high. Excavation progress remained behind schedule. Internal forecasts projected insolvency. Attempts were made to secure additional legislative authorization. Political support weakened as doubts increased. Investors began to question official assurances. Share prices declined steadily. Speculative volatility intensified. Confidence began to erode. Without continuous inflows, payroll could not be maintained. Equipment suppliers demanded payment. Creditors tightened terms. Short-term borrowing options diminished. In early 1889, liquidity was effectively exhausted. Construction activity slowed further. Work sites reduced labor forces. Contractual obligations could not be honored. On 4 February 1889, the Compagnie Universelle entered liquidation. The bankruptcy halted construction. Operations ceased. Assets were frozen. Approximately 800,000 investors were affected. Many were small retail savers. Total losses were estimated near 1.2 billion francs. The collapse represented one of the largest financial failures in French history. Public outrage intensified. Newspapers shifted tone. Confidence in parliamentary oversight weakened. Financial markets experienced shock. Shareholders realized that projected toll revenues would not materialize. Bondholders faced substantial impairment. Dividend expectations were eliminated. The illusion of continuity with Suez was dismantled. The sea-level design had not been completed. Engineering realities had outpaced financial planning. Political insulation could not prevent insolvency. The structure had relied on continuous funding. When funding stopped, the system collapsed. The company's books were scrutinized. Deferred losses became visible. Accounting adjustments were exposed. The gap between disclosure and reality became evident. Retail investors recognized the scale of exposure. Savings accumulated over decades were lost. Institutional credibility suffered. The failure extended beyond engineering. It revealed structural weaknesses in financial governance. Infrastructure ambition had been sustained by leverage. When leverage expired, confidence failed. The bankruptcy of 1889 marked the end of the original French canal enterprise. The project remained unfinished. The investors remained uncompensated. Following the bankruptcy of 1889, investigations began into the company's conduct. Initial reviews focused on financial mismanagement. However, evidence of political bribery gradually emerged. Journalists began publishing detailed allegations. By 1892, formal inquiries were underway. Documents revealed payments to members of Parliament. Approximately 150 deputies were suspected of receiving funds. The payments were intended to secure bond authorizations. Intermediaries had distributed money discreetly. Some journalists had also been compensated. Public confidence deteriorated further. The scandal extended beyond engineering failure. It implicated the French political establishment. In November 1892, arrests were made. Executives of the canal company were charged. Ferdinand de Lesseps was indicted. His son, Charles de Lesseps, faced prosecution. Company officials were accused of fraud. The charges included misrepresentation of financial condition. Parliamentarians faced accusations of corruption. Court proceedings attracted national attention. Newspapers reported extensively on testimony. Financial records were entered into evidence. Internal correspondence exposed deferred losses. Accounting practices were scrutinized. The scale of concealed deficits became public. Retail investors realized that disclosures had been incomplete. The legitimacy of prior bond approvals was questioned. Political reputations were damaged. Some deputies resigned. Others denied wrongdoing. Trials proceeded through 1893. In February 1893, Ferdinand de Lesseps was convicted. He was sentenced to imprisonment. Due to age and health, the sentence was not enforced. Charles de Lesseps and other executives also received sentences. Appeals later reduced certain penalties. Nevertheless, the reputational damage was permanent. The scandal weakened public trust in Parliament. Confidence in financial markets declined. The affair became known as the Panama Scandal. It was one of the largest corruption cases of the Third Republic. The exposure demonstrated how political incentives had aligned with financial survival. Legislative approval had been influenced by private payments. Media support had been subsidized. The project had relied on institutional protection. When bankruptcy removed financial cover, investigations advanced. Disclosure followed collapse. The separation between state and speculation had blurred. The scandal reshaped debate about regulatory oversight. It reinforced the need for transparency in public offerings. The political cost exceeded the engineering loss. By 1892, the Panama enterprise had become synonymous with corruption. The infrastructure failure had evolved into a governance crisis. The collapse of the Panama Canal Company affected approximately 800,000 investors. Many of them were middle-class savers. Teachers, shopkeepers, civil servants, and retirees were exposed. Savings accumulated over decades were invested in bonds and shares. When liquidation occurred in 1889, most capital was unrecoverable. Losses approached 1.2 billion francs. The magnitude of the failure exceeded prior French financial scandals. Provincial towns were heavily impacted. Local banks faced withdrawal pressure. Confidence in public offerings declined sharply. Retail participation in infrastructure ventures contracted. The Paris stock market experienced reputational damage. Speculative enthusiasm gave way to caution. New share issuances in unrelated sectors struggled to attract subscribers. Government credibility weakened. Parliamentary approval was no longer viewed as reliable assurance. The scandal undermined faith in regulatory oversight. Political instability increased within the Third Republic. Opposition parties used the affair to challenge incumbents. Public debate intensified around financial transparency. Calls for stronger disclosure requirements expanded. The relationship between media and finance was questioned. Journalistic independence became a national concern. Bond markets reflected heightened risk premiums. Investors demanded stronger guarantees. Small savers diversified into safer instruments. Savings deposits increased relative to equity purchases. Entrepreneurial ventures encountered more scrutiny. The memory of Panama influenced investment behavior. The term Panama became synonymous with corruption. Financial advertising faced skepticism. Prospectuses were examined more closely. Legislative reforms were proposed to regulate bond issuance. Oversight mechanisms were gradually strengthened. However, the reputational damage endured. Trust, once eroded, required time to rebuild. French capital markets entered a more cautious phase. Infrastructure ambitions slowed temporarily. International observers questioned French financial governance. The scandal affected diplomatic perception. Domestic political discourse hardened. Retail investors reduced exposure to speculative ventures. The cost of capital increased for large projects. Lenders incorporated political risk into evaluation models. Institutional investors demanded audited reporting. The episode reshaped expectations regarding transparency. Infrastructure financing became associated with heightened scrutiny. The economic impact extended beyond immediate losses. It altered behavioral norms in French finance. The collapse demonstrated that national prestige did not eliminate risk. Confidence required evidence. After Panama, evidence was demanded before capital. After the French bankruptcy in 1889, the Panama Project remained unfinished. Excavation sites were abandoned but not erased. Machinery and partial infrastructure remained in place. The canal route had been partially cleared. French investors had absorbed the losses. However, the geographic logic of the canal did not disappear. Global trade still required a shorter Atlantic-Pacific passage. By the early 1990s, international interest resurfaced. A new French company was formed in 1894. Its purpose was to preserve remaining assets. The objective was no longer immediate completion. Instead, it sought to sell the project. Engineering analysis shifted toward practicality. The sea-level design was reconsidered. Lock waste alternatives gained credibility. In the United States, strategic interest expanded. American naval doctrine emphasized two-ocean mobility. Control of a canal aligned with military objectives. Commercial shipping interests also supported the concept. In 1902, the United States Congress passed the Spooner Act. The act authorized negotiation for canal assets. The United States agreed to purchase French holdings. The purchase price was approximately $40 million. The transaction transferred equipment, land rights, and surveys. American engineers reassessed the design. They rejected the sea-level approach. A lock canal system was adopted. Medical research addressed tropical disease. Understanding of mosquito transmission improved. Sanitation campaigns reduced yellow fever and malaria. Engineering management became centralized. Cost projections were recalibrated. Construction resumed under revised assumptions. Political negotiations shaped regional control. In 1903, Panama separated from Colombia. The United States secured canal zone rights. Work accelerated with improved logistics. Heavy excavation continued through the Culebra Cut. By 1914, the Panama Canal was completed. The structure differed fundamentally from the original French vision. Locks replaced sea-level excavation. Water control systems managed elevation changes. The canal transformed global shipping. However, original French investors did not recover losses. Their capital had funded partial groundwork. The economic benefit shifted to another nation. The assets survived. The initial financial structure did not. The American completion demonstrated that engineering was feasible. It also demonstrated that design assumptions mattered. The French failure was not purely geographic, it was structural. Capital had preceded feasibility. Oversight had lagged behind ambition. The project succeeded only after incentives were realigned. The Panama Canal scandal followed a recognizable structural pattern. It began with a successful precedent. The Suez Canal established credibility. Reputation reduced perceived risk. A celebrated leader proposed a larger project. National pride reinforced belief. Technical objections were minimized. Ambition defined the initial design. Early cost projections were optimistic. Public share offerings expanded participation. Retail investors provided substantial capital. Bond issuances extended financial exposure. Lottery structures widened the investor base. Engineering complexity was underestimated. Operational costs exceeded forecasts. Revenue generation was deferred. Additional capital substituted for progress. Accounting practices delayed loss recognition. Political endorsements reinforced legitimacy. Legislative approval encouraged continued investment. Media support amplified optimism. Critical analysis was marginalized. The structure became dependent on continuous funding. Confidence became the central asset. When funding slowed, vulnerability surfaced. Debt obligations intensified strain. Liquidity exhaustion triggered collapse. Disclosure followed insolvency. Corruption investigations exposed concealed incentives. Institutional credibility deteriorated. Retail investors absorbed the losses. The asset itself retained strategic value. However, the original financial structure failed. This sequence is not unique to Panama. Infrastructure projects attract large-scale capital. They promise measurable economic return. They often rely on complex engineering assumptions. When ambition outpaces feasibility, risk compounds. Political alignment can postpone recognition of failure. Optimistic projections can delay corrective action. Public participation increases systemic impact. Retail exposure amplifies social consequence. Continuous refinancing can mask operational weakness. Transparency becomes secondary to momentum. When liquidity disappears, structure is revealed. The Panama scandal illustrates this mechanism clearly. Credibility can substitute for scrutiny. National narratives can override technical caution. Financial architecture determines sustainability. Engineering projects require capital, but capital requires verification. When optimism replaces oversight, infrastructure becomes speculation. When speculation dominates governance, collapse becomes inevitable. The lesson is structural rather than historical.